Is it possible to profit in a flat market? Well, you know how to make money in a bull market, you just buy stocks or assets. And then you could profit in a bear market by shorting stocks or assets. But you think, well, if the market isn't going anywhere, can I still make money? Well, actually, there are some strategies that you can make a profit in a flat or even choppy market. So let's look at some of the ways that you can profit in a flat or choppy market. One of the first strategies is you want to use options, and one of these option strategies that's considered neutral, where it doesn't really profit in a bear market or in a bull market, but in a flat market, is called a calendar call. So what is a calendar call? A calendar call is, instead of buying and selling a spread option that's within the same calendar month, you will buy an option that's 6 months or 12 months or 3 months out, that's in the future, and then you sell the front end option. So for instance, let's say you want to use the SPY, the S&P 500 ETF, and let's say the price of the SPY is 250. So what you would do is you would buy a 250 option that expires 6 months from now, and let's say the price on that one is $10, and then you sell the front end 250 option, and that option might be $2.50. So you get a net debit of $7.50. The market doesn't move anywhere. The $10 option that you paid for will remain stable, while the 250 option that you sold will expire worthless, and then you turn that 750 that you paid in net debit, that could turn into $10, and you can make about anywhere from 10 to 15 to 20%. So you can make a really good return just when the market doesn't move. Another option that you can do is a covered call. Now, covered call is more of a bullish strategy, but it can make money in a flat market. So for instance, let's use the SPY again. If it's at 250, you just buy 100 shares of the SPY ETF, and then you sell that front end option where you get $2.50, which is that option cost will be $250. And if the market doesn't move anywhere, your stock doesn't gain or lose their price, but then that option expires worthless, and you make $250 for the month. And that's a pretty good return. That, with a covered call, you could expect 1 to 3% return in a flat market per month, and that's a very respectable return that beats not making any money in a market. But covered calls is usually probably the safest strategy you can use in a neutral environment. And then the third strategy is known as a butterfly spread. So unlike a calendar call, all the options you'll buy in a butterfly spread will be in the same month. And they're usually, in most spreads, when you think about option spreads, there's usually you buy an option and sell an option. There's usually what you call two legs. So you buy at one strike price and sell at another strike price. With a butterfly, you actually use 3 strike prices. It's kind of interesting. What you do here is you buy a deep in the money call. So let's use the SPY ETF example. If the SPY is trading at 250, let's say you buy one option at 240, so it's deep in the money, it's 10 points in the money. And then what you want to do is you want to sell two contracts at the money at 250. So you buy at 240, you sell 2 contracts at 250, and then you're going to buy one more option that's really out of the money, usually at 260. And the great thing about this strategy is if you do the spread right, it will cost you almost no money. So let's say, for instance, you buy that 240, that deep in the money call, for about $4.50. And then you sell the 2 options that are at the money at $2.50 a piece. And remember, you're selling 2 contracts, so you get $5. You sell those at $5. You bought that deep in the money call for $4.50, and then you buy that out of the money call for, let's say, about 50 cents. You can end up actually spending no real money to open this option spread. You're just paying for the cost of the trading fee, and you have an opportunity to profit. So it's almost like a free roll if you do that a butterfly option correctly. So if you don't have a lot of money, a butterfly option spread is one of the best strategies you can use, because you're going to buy 2 calls at 2 different strikes, and then you're going to sell 2 calls at the money, and you could definitely create that spread where it really costs you little to no money to open that spread, and then you have a chance to make a really good profit off of it. So if you want to profit in a flat market, look at these option strategies: the calendar call, the covered call, and the butterfly spread. Okay, so I hope you enjoyed this video. If you did, please be sure to like, share, and subscribe. Thank you. Bye.